Hi, well, I just wanted to cover a quick topic that came up today. I had a client that reached out and was interested in a property that had an assumable mortgage. That's, of course, been a popular thing here as of late because many people that are selling their properties today have got lower interest rates, for example, of a house that they bought 3 or 4 or 5 years ago than what we have currently today. And so, as a part of the selling process or an incentive, they are offering to sell their property and for the buyer of that property to assume the mortgage. And that can be a very attractive situation for a potential buyer, but there has to be certain pieces of the puzzle in play in order for you to make that work. Number one, the existing mortgage on the property, the subject property that's being sold, has to be an assumable loan. Not all loans are assumable, and so it would be up to that seller to verify with their current lender if the loan that they have is an assumable loan. That's step number one, and typically a listing broker should be verifying that before they offer a property up for sale in that manner. But the second piece that a buyer has to really consider is, and this came up on this scenario today, where the let's just say that the property was for sale for 400,000, and the seller had a loan for 300,000. So that loan for 300,000 is assumable at a low interest rate, which is all well and good. But the buyer, in order to execute on that assumable loan, has to come to closing with the difference. So with that basic math I just went through, if they're going to purchase the property for 400,000 and the existing loan is 300,000, then the buyer would have to come to closing with $100,000 to bridge the gap between those two, the price and then the loan amount. And then on top of that, they'd have to come to closing with a little bit of money for their closing costs. Now, the closing costs are going to be significantly less because they're not actually getting a new loan. They're assuming the existing loan. So there isn't as much closing costs involved, but there's still costs involved with closing on the new transaction. So anyways, it just was an interesting topic. I get a lot of questions around um, this topic, how it works, and the process at hand, and all that. So I thought I'd shoot a quick video on it. The other thing too is, because of this situation, as you can imagine, the lenders that have these assumable loans, a lot of these assumable loan departments are way behind on their processing of these because of the popularity of these. So all of a sudden, overnight, so to speak, when people had these properties that they were trying to sell, started off these assumable loan options when the interest rates went up. All of a sudden, these assumable departments within the lenders became very, very busy very quickly. So the last assumable loan transaction that we actually closed was more like a 90-day escrow period. That's just the time it took for the assumable loan process to be completed from start to finish. So if you're a buyer and you want to consider a property with an assumable loan, you also have to know that it's going to take considerably more time to close. A typical closing for a new loan would be, say, 30 days. An assumable loan, you're going to want to budget more time than that. And of course, it's lender specific. Some lenders aren't backed up as much as others, but across the board, the process is taking much longer than we typically experience, just because of the demand that's going on for this type of situation. So anyways, if you have any further real estate related questions, my cell phone is always the best place to reach me. It's 206-949-3793. You can call or text, and look forward to chatting with you soon.